All right, let's talk ChargePoint. Their Q3 earnings just dropped, and wow, it sent a jolt through the market. I mean, this stock has had a punishing year, right? And then suddenly it comes roaring back to life. So the big question is this for real? Is this the start of a genuine turnaround or just a temporary bounce? We're going to dig in and find out. So, first things first, let's look at how the market reacted. And it was explosive. In just 2 days, the stock shot up a whopping 22%. I think it's safe to say that caught pretty much everyone off guard. So, what on earth was in that earnings report to cause a rally like that? Let's get into it.
Okay, it all starts with the headline numbers. And boy, did ChargePoint deliver a surprise here. This is exactly what investors had been hoping to see. All right, let's break down the actual numbers. So revenue came in at over $105 million. That's a solid beat against what analysts were expecting, and really importantly, it signals they're back to growing year over year. Non-GAAP earnings per share, also a nice little beat. But, and this is a big but, the official GAAP EPS was a pretty significant miss. So what gives? This is where it gets interesting. So you're probably asking, why is the stock soaring if they had a big miss on GAAP earnings? Well, it's because the smart money was looking past that. They were focused on the operational story. See, non-GAAP numbers strip out things like stock-based compensation, stuff that doesn't really reflect the day-to-day health of the business. It gives you a much cleaner picture of their actual performance. And on that front, ChargePoint showed some real, tangible progress. That's what everyone got so excited about. And that progress brings us to the story that management was telling, because they didn't just drop some good numbers on the table, they laid out a really compelling narrative about a full-blown strategic turnaround. So, what were the big wins they highlighted? Well, first, they're back to growing revenue again. That's huge. They also hit a record non-GAAP gross margin of 33%. That's a fantastic number. Plus, they showed real discipline on their spending, with operating expenses actually down year over year. On top of all that, they launched a new software platform and, maybe most importantly, did some serious repair work on their balance sheet. You see, this wasn't just about one good quarter. They're trying to signal a real foundational shift. Yeah, speaking of that balance sheet repair, check out this quote from the CEO, Rick Wilmer. This is really key. They did a debt exchange that slashed their total debt by more than half. We're talking $172 million. That's a massive deal. It means lower interest payments, more breathing room on when they have to pay it back, and, like Wilmer says right here, it shifts value back to the shareholders. This was an absolutely critical move to de-risk the company. And another huge piece of this turnaround puzzle is how their revenue is structured. You know, it's not just about how much money they make, but how they make it. And right now, their high-margin subscriptions make up almost 40% of the total pie, and that slice is growing at 15% a year. Now, for any investor, that's music to your ears. Why? Because it means they're shifting away from one-off, less predictable hardware sales towards that sweet, stable recurring revenue. That's a much healthier business model. Okay, but let's pump the brakes for a second. It's easy to get carried away with one great quarter, right? But one good report doesn't just erase a whole year of terrible performance. To really understand what's going on, we have to zoom out and look at the pretty tough road that's still ahead for ChargePoint. And here's some perspective for you. Even after that huge 22% pop, the stock is still down, wait for it, over 60% in the last year. 60%. Now, compare that to a general clean energy fund, which is up over 42% in that same time frame. That is a massive, massive gap. It just goes to show you how deep a hole they've been in and how much work they have to do to win back investors' trust. So what's the biggest headwind they're facing? Well, it's the whole EV market. Things are slowing down. I mean, here in the US, EV sales growth has hit a wall. It went from a blistering 46% growth in 2023 all the way down to just 7% this year. And, you know, it's simple math. If fewer new EVs are hitting the road, there's just less demand for new public chargers. So what's the game plan? How is ChargePoint going to fight through this tougher environment? Well, they've laid out a pretty clear three-part strategy. First, they're doubling down on that high-margin software and subscription business we talked about. Makes sense. Second, they're getting super aggressive on cutting costs for their hardware. And third, they're leaning on key partnerships, like the one they have with Eaton, to help them innovate without having to spend a ton of their own cash. It's a smart playbook. All right, so that brings us to the big finale, the next call. We've looked at the numbers, we've heard management's story, and we've sized up the challenges. So now it's time to put it all together and figure out what comes next.
So, what's the verdict? What does the future really hold for ChargePoint? Is this new momentum the real deal, or was this just a flash in the pan? Okay, so looking ahead to next quarter, management gave guidance for revenue between 100 and 110 million. Now, what does that tell us? It suggests they see this modest growth continuing, and it's actually just a little bit better than what the street was expecting. It's a solid forecast, confident, but they're not getting carried away. But let's be crystal clear, the path to actually being profitable is, well, it's a long one. This quarter was a fantastic first step, no doubt, especially with those record margins. And they expect to keep growing, maybe even faster in the second half of next year. But, and listen closely here, getting to the point where they break even, that's still a goal for 2027 or maybe even later. So if you're an investor, you've got to be prepared to be very, very patient. And so here's our final call. We're reading ChargePoint as market perform. Look, the great quarter and the much healthier balance sheet are absolutely huge positives. You can't ignore them. But the headwinds from the slowing EV market are very real, and that super long road to profitability just adds too much risk to be more bullish right now. It was a great, promising step forward for sure, but now they have to prove they can do it again and again.
And just a quick reminder for everyone, this is not financial advice.